Vora, CIO at Trust Mutual Fund, who's joining us on the show. Mihir, hi morning, and thanks so much for taking the time out to speak with us this morning. You know, there's earnings, there's tariffs, there's lots of moving parts to address in the market right now. Amid all of these factors that are at play, how are you viewing the market right now, and where do you think we can still find some value?
Sure. Good morning. Thanks for having me on the show. Uh, I would say the market is in a wait and watch kind of a mode, or I would say a wait and watch level, because after the sharp correction that we saw in the first quarter, we have recovered very smartly, and we have recovered in spite of all the domestic and global events like tariffs, the border situation, etc. So lots of moving parts, and the market has sustained very well against all those odds. So now I think we are at a stage where both the negatives and the positives are kind of evenly balanced and evenly priced in. And going forward, I think we'll have to now look forward to our own domestic fundamental growth, which is something that we are very closely observing. For example, there are, I would say, mixed signals on the growth side. There are pockets of recovery, but there are also pockets where there is persistent weakness. So the results season and the guidance that the companies give, as well as the next few data points on growth, especially credit growth, are something that we are looking forward to now.
Absolutely. Mihir, good morning. I completely second the thought. It's the domestic triggers which we need to keep an eye on. And yes, the economic indicative actions domestically are at least good if we have a look at the inflation print and also comparing it with the other markets. But at the same time, talking about the earnings season, there were expectations from the IT basket. And with the TCS IT major coming up with the numbers, and now we have the other IT majors also, which will be coming up with its numbers. But the expectations are high for banks and financials. What's your take on the earnings season? Will it be the banks and financials or the consumption bucket which will give next direction to the market?
See, as far as the large banks are concerned, we don't have extremely positive signals yet because the key variable, as I mentioned, credit growth, that is still tepid. So within banks and financials, we would still look at the NBFCs, especially the retail lending NBFCs, which have a relatively higher proportion of a fixed rate book because funding cost is going to come down for everybody. But in the case of banks, a lot of the loans are floating rate, so the asset repricing also happens a bit faster. Whereas for NBFCs, which have a fixed rate kind of a book, their asset repricing happens over a period of time. So I would say that the retail NBFCs, certain pockets of banks which are in niche segments like MSME or retail or gold or even microfinance, those pockets might show you better margins and better growth. So we have to be picky and choosy. Having said that, the markets can't do well, the economy can't do well unless the really large banks kick off. And in that case, the valuations are attractive in any case for most of the large banks. No issues. Balance sheets are clean. Only thing we need to watch for is growth. And right now, the default case is that the second half after the monsoons should see a pickup in growth. I think that's what we would start positioning ourselves for.
So, Mihir, in terms of a portfolio strategy right now, what is it that you're doing, given that there are so many unknowns like we just talked about, which are still up in the air? Do you think doing nothing is the best strategy right now?
Absolutely. I think, as I said, since we are in a wait and watch mode, the market is in a consolidation mode because you don't have the absolute downside, in valuations. Valuations are fair, probably a little above average. So it's not like you have extremely cheap valuations to start with. And at normal rates, you would need earnings to come back to normal, rates. My guess is that it's going to be a stock pickers market. Mid caps and small cap, at least from the last quarter numbers, it looks like they have a far better story out there. And the sheer number of stocks is much larger in the mid and small cap segment. So next few months, probably, it'll be very, very sub-sector specific, very, very stock specific kind of a market.
And what sectors do you think are going to find their day in the sun right now?
Uh, so I think the visibility, the sectors in which there is visibility are still linked to government spending. So the government spending does not seem to have come off. So to that extent, I think we will see, that infra push, the power, telecom, defense push continue, and you should see news flow in this segment to continue. So that's one segment where, relatively speaking, there is better visibility. As I said, the retail financing space, there seems to be better visibility. Some pockets of rural financing like microfinance also might be a play now because valuations had corrected. Government is spending a lot on the rural economy. So rural economy seems to be on the healing path, so to say. And microfinance, of course, is a direct beneficiary of that. So microfinance, small gold loans, etc. Those segments can continue to do well. You might see some base effect in a lot of the capital goods stocks because last year was a low base. So that's a positive. Some base effect in the metals piece. So there might be some pockets of value out there. So it's really very picky and choosy. We are structurally underweight on large cap IT because, as we discussed, it's a single digit growth rate kind of environment. For guidance also is more or less according to that single digit, not very exciting. FMCG growth again is not very exciting. So IT, FMCG, low growth utilities, those are the segments which we avoid. We are more positive on the domestic segments. Hopefully consumer discretionary should also come back. Stocks have corrected a lot. Some of the AC stocks, etc., they have corrected. So they might offer some pockets of value. So as I said, it's going to be we are kind of really being choosy and picky about where the growth pockets are.
Right, Mihir. So government spending as a theme is something you're liking at the moment. But another theme that we're seeing that's showing some value right now is domestic demand-focused themes in stocks. Given the kind of tariff overhang that we have, and like you rightly mentioned, we're in the wait and watch mode right now. What is your take on this entire domestic demand-focused theme and some stocks that are servicing that theme? What are you liking from this theme?
See, as I said, the rural recovery is a theme, but I would still wait for some more data points. It is still tentative. I wouldn't say it's a full blown recovery. Same for urban. You are getting mixed data points on urban unemployment, etc. The visibility in consumption is still in the premium consumption category. So I think wherever there is premiumization or premium consumption, those categories are still showing some traction, like high end say retailing or jewelry or eating out and those kind of. There, I think it's a little more less elastic, I would say. But in general, the lower end consumption is still a question mark.
Absolutely. Mihir, I hear you when you say that we are in a wait and watch mode at present, and caution is something which one should practice. But at the same time, there's always a debate whether to stay with the benchmarks or to move to the broader markets, and that comparison always stays. Having said so, what's your stance on the broader market performance right now? If we see the mid cap and small cap, we have seen days where the broader markets did support the market, where the benchmarks were quite volatile. And at the same time, while we talk about earnings and taking it little ahead from there, will there be any positive surprises, particularly sector specific in the earnings? Because last quarter we did see PSU, defense, railways were positive surprises. Any such themes in your mind right now?
No, absolutely. As I mentioned, even last earnings season, the pockets of excitement or good results were in the mid cap and small cap space. So to that extent, I think that trend should continue because see, if you see most of the emerging sectors or the higher growth segments are typically not represented in large caps. Large caps are more stable, mature sectors. But all the smaller sectors which are coming off from a low base or growing for the longer term for a low base, they typically tend to be in the mid and small caps. So whether it's auto, ancillaries, CDMO plays, these are all typically in the high growth plays are typically in the mid and small cap space. So I think the stock picking opportunities will definitely be in the mid and small cap space. The number of stocks available to choose from is also far larger. At least 600 stocks to 800 stocks to choose from in the mid and small cap space. So I think that stock picking opportunity in India is always there. Even if the market remains sideways, we will always find good opportunities. As far as results are concerned, as I discussed, there are segments in capital goods, construction, government spending, even in pharmaceuticals and CDMO plays, you will see pockets of good results out there. Some mid-cap IT can also show good results.
Okay, Mihir, you did speak about pharma and CDMO in terms of earnings, but what are you making of this sector overall, given the kind of overhang we have of that 200% Trump tariff, wherein very recently, I believe last evening, Trump has said that these pharma tariffs could come into play by the end of this month, along with something on semiconductors as well. Amid a market like this, the overhang that we have on pharma, what would you recommend for our viewers who are already invested in this space? Should they just wait and watch, or what should the strategy be for pharma?
See, in pharma, first of all, the probability of Trump dramatically increasing tariffs on pharma, I would say, is not that high, because it will be like shooting themselves in the foot. So while the intention is good that ultimately you do need to manufacture drugs and bulk drugs and APIs in the US, it cannot happen overnight. India and China are the largest suppliers of most of the drugs and intermediates, and that's going to remain that. So I mean, if they hike, the tariffs on pharma imports into the US dramatically, then it can feed into inflation immediately, and it hurts the lowest, the poorest of the consumer in the US the most. So we have seen that Trump has this tendency to announce something big and then then withdraw. We call it the taco trade, as you know. Pharma is the most sensitive, I would say, and the probability of something like that happening is very low. Especially in CDMO, where a lot of innovators are working with the local companies to commercialize their drugs. So, innovation can come to a grinding halt, R&D can come to a grinding halt. So, probability of something happening dramatically is there. Having said that, of course, it's a risk. So, I would not say that if you have exposure to pharma, you should go and sell it. But if you're looking to increase, then probably you might want to, just stagger it out over the next few weeks, because I think the decision will be out in the next few weeks. Again.
Okay, I believe we have snapped that feed with Mihir, but that was Mihir Vora of Trust Mutual Fund sharing his views on what he thinks could happen in the tariff, in the pharma space going ahead in terms of tariff, and how should you be positioning your portfolio amid the given market volatility. But on that note, we